Okay, good afternoon, everybody, and welcome to Challenge Day 8, Bankroll Management. My name is Lee Goldstein, the Trading Director at 10-Minute Trades. It's nice to be here. So we're going to get started. Anybody got any questions before we start? If you want to ask me anything, definitely you can be free to ask me any questions right now. If not, we're going to get started. It's an important subject. Everything's important, really, if you think about it. Everything fits together. So before we start on the bankroll management and just some trading tips and things like that, yesterday I had some trouble with my videos not playing back properly. So I just wanted to show you a couple of trap trades working perfectly with the video because it was an important lesson and I just feel like I didn't make the point I wanted to make. So first off, we do have a DMM that when there is a full-blown trap trade, um, with 6 months of data, you'll see it looks a little bit different than our regular DMM, but you can see the way it's explained, inner tier fill, outer tier fill. Assume that if an outer tier is filled, the inner tier gets filled also, obviously, because the outer tier is further away. Okay? So it's important to know that we do have DMM trap trades as well. Retail sales is one of our more popular trap trades. So I just wanted to show you a recent retail trade as a trap trade because there were a couple of features I wanted to make sure everybody understood. So just as a brief recap, a trap trade puts two orders below the current price. The orange arrow is our current price, two orders above. And we are trading in the opposite direction of the orders. If the market goes up, we sell and go short. If the market goes down, we buy and go long. Very simple. Also, that's a good type of trade to do in low liquidity or when there's low volume. Helps you to get better fills. So you could see retail in December, it's going to move, and I believe it's going to fill one tier right there. And let's see, it goes up. And here's why this stop is so important on a trap trade. So there is something that I call the zone of safety on a trap trade. Your zone of safety is the outer tier plus your stop. So for instance, if you look at the DMM that we just traded, our outer tier, tier 2, has an outside range of 30, okay? And the stop is 18. The zone of safety is 48 ticks, 30 plus 18. If the move is contained less than 48 ticks, we will have very possibly a great trap trade, okay? In this particular case, look what happened with the price. It almost hits the stop. That's why the stop is so important. And we arrive at those values by studying sometimes up to 2 years worth of reports. It's awesome if we can get a trap trade that's been safe for the past 2 years. Usually we try to get 6 months to a year if we can. But you could see this particular trap almost stopped us out. It bursts up, fills the second tier, and then shoots up and then stops and starts to change direction. Okay. And it made me a little bit nervous because it was hanging around near the high of the day. The other feature that we talked about that I wanted to show you was the combined feature. The combined feature is very convenient for the trap trade, just as it is for a breakout trade. It takes the two positions or three that you have open on the chart, combines them into one position at the closest area to the current price, the closest order to the current price. So the combined will move this order to here. All right, watch. You know what? I did it manually, but had I pressed the combine button, it would have done the exact same thing automatically. That's what the combine button does. Then, see, it makes it easier to move your orders. If you have a trade that's not exploding and you're not expecting it to hit your targets, both of them, you can combine the orders to make it easier to get out of the trade and to manage your way out of the trade. All right. And let me just show you one other, just a fast moving trap trade so you could see, how a trap trade looks when it's working. And this was a WASD trade. Ironically, we traded WASD today, and it wasn't a great trap trade. It was a decent breakout at best. This was a WASD that was very, very good as a trap trade. You could see price goes up. It filled both tiers. So we're now short, really fast reversal. Now, sometimes when the reversal's that fast, boom, I just hit the close button to get out of the trade. Um, I didn't want to waste time managing my way out of the trade, which truthfully, most times don't rush. Most times do it the right way. Had I managed my trade, I would have made more money because I rushed out. And if I had managed it, price was still reversing. I could have taken a bigger profit. So try to develop patience. We know that sometimes patience works against you. It does. There's no one size fits all to trading. Sometimes the way you manage your stop can cost you money. Other times it will make you money. And we're going to talk about that a little bit today also. And we're going to talk about margins and micros. Okay. So, what is bankroll management? It's not complicated. It's a very simple concept. It's just the practice of managing your money so you minimize the risk of losing the money while you're maximizing your profit. That's all it is. Managing your money. And what does that mean, managing your money? It means deciding how much to risk on a particular trade. Maybe some people like to have a loss limit, how much money you're willing to lose in one day, a winning limit, how much you'll stop trading if you make X amount of dollars. Now, me personally, I don't usually use either of those levels to help me trade, especially because of the way that we trade. Like, look at what happened today. What if you have a winning limit of $400? And that's what you want to make every day. And if you make $400 in a day, you're going to stop trading. Well, because of the way that we trade, report by report, where it's as if you're starting fresh every single trade, having a limit doesn't really make sense because why pass up a report that has a fantastic opportunity for profit just because you hit a random number that you've set for yourself? What if I would have stopped trading after the WASD report and the beige book was an $800 winner? It would have made no sense. So I really believe because of the way that we trade, it's better not to have those limits. Think about if you have a whole bunch of losers and you have just a bad, miserable day, and it happens. It's going to happen. You're going to have a lousy day. You're going to have more than one. And you're faced with a great report. Isn't it nonsensical not to trade it if your probabilities are really good that the report's going to be a winner? I think it makes more sense to treat each report as an individual and make the decision based on the report. Today, the beige book really didn't seem to be offering a great profit opportunity, so we didn't trade it. And you know what? We happened to be right. It wasn't a great profit opportunity. It was not a obvious profit opportunity. It made more sense to just let the market absorb the report and pass on it. Okay? And that's one of the features of bankroll management is setting a budget or a capital allocation. for trading, and you try to use that budget in a strategic way so that you could possibly limit your losses and profits. But I maintain that because we're different than most other trading companies, that's a form of bankroll management that most people follow, but I'm not so sure that we should. And obviously, it's your own personal decision, but I'm willing to take a trade when I'm down big on a day, especially if it's a trade that I love. So I think that's an important part of your bankroll management. And then there's a lot of, I almost call it an old wives' tale about, well, don't risk more than 5% on any given trade. And I'm kind of, maybe some people would say I'm irresponsible, but for instance, take today's WASD trade. I was willing to risk a 30 tick stop on each contract, and I knew my profit wasn't going to be as big as my potential loss. I was willing to risk $900 on the trade, and it's always approximately $900. It's always your stop is always approximate. You can trade in a very fast market. You could have a 30 tick stop, and your stop could be a 38 tick stop. In other words, the market might shoot through the stock 8 extra ticks because the market's so fast. Just like the market could give you 10 ticks of extra profit because you're exiting fast in your direction, it could take ticks away by giving you a bigger and worse stop. We've talked about how slippage is a wash. Sometimes it's positive, sometimes it's negative, but it's really not either one of them more than the other. It just seems like it's always the worst ones that you remember and the good ones you always forget because the worst ones hurt more. That's just human nature. So I really believe that I'm willing to trade a report, even if it's not 1 to 1. That's the other, what I call an old wives' tale. A lot of people say, oh, I'm not taking a trade if it's not at least a 1 to 1 risk. I've got to be able to make what I'm going to lose. No, that's silly. I mean, it's like that WASD report. That WASD report, trading soybeans, was 80% profitable over the past 6 months. 80%. I'm not even looking at the 1 to 1 risk. I don't even care what it is. I mean, I care. Don't be, I'm not, I'm just trying to make a point. I care, but it's not my first important thing that I'm dealing with. I'd rather, those are the reports I want to up my contracts on and take extra risk. If it's an 80%er, I'm taking extra risk. And if it's a 1 to 2 or a 1 to 3 where I'm risking double what I'm going to win, I'm still willing to do it because remember what's so important about the stop. So many times you're taught two stupid things about the stop. One thing that people are often taught is never move your stop. Oh God, never move your stop. I was taught that way. It's ridiculous. Of course you're going to move your stop. Moving your stop management is one of the most important things that we deal with. It's so important. Yes, there's times you don't want to move your stop. You know what? If I didn't move my stop during today's bond report, I would have made more money. So there are plenty of times, yes, don't move your stop, but there's plenty of other times you want to move your stop. Today's WASD report, it didn't move as far. The WASD report today is a great lesson. And if let's look at it for 1 second, it didn't have as explosive a move as we thought that it would. So it doesn't mean you panic, but it means you got to think fast and you got to think on your feet. And it's all bankroll management. Everything we do is bankroll management because deep down, no matter what we do, we're always trying to protect our money. We're always trying to keep as much money in our bankroll as possible. It's all bankroll management. It's just that you don't want to follow old wives' tale rules just because somebody and his brother made up these rules. They don't always apply. So the WASD today. It did not explode nearly as far as we thought. So we needed to think on our feet. First thing I needed to do was shrink my targets. They were too big. It was clear that this report was probably not going to get to those faraway targets. So it only makes sense to shrink them. Now, I didn't have to combine them. Ultimately, I did because I made a mess out of moving them, right? It's easier sometimes to combine them. And then I could, before I did anything else here, I could just have easily moved my stop up, and it would have made total sense to shrink my stop at that time because there's no reason to take a full stop out when the trade is not challenging the stop and it looks like it's going to just hit your little targets and get you out of the trade with a win instead of a loss. Okay. So point taken here is no shame and nothing wrong moving targets, moving stops, trading with a little bit more risk on the good reports to make more money on those reports. That, in my opinion, is actually smart bankroll management because the whole idea of bankroll management is to make as much money you can, saving and being safe with your existing capital. Okay. And that means rational and disciplined choices. Okay. And the key word there is choices. That's what it's all about, making choices. All right. Any questions? Does anybody disagree? Anybody disagree? What do you think? Do you agree that you want to be flexible with your bankroll management? Type in yes or no. Or do you think a system is a system and you should always follow the system? Type in yes, flexible, no, a system is a system. What do you think? Tell me what you think. I'd be curious. Bruno is a yes. Michael is a yes. Muriel's a yes. Matt is a flexible yes. I think it just makes sense. And I'm not going to yell at you if you're a no. You're allowed to think that way, and you can trade that way also. I think that you will save some extra reports if you trade being more flexible. That's what I think. All right. Now, liquidity is an issue that can affect trades and bankroll management also. What is liquidity? So, liquidity is the amount of orders that are available when you trade. Sometimes, when you see an explosion in price and you see a very, very big wick rather than a full size candle, sometimes that wick is showing you low liquidity. Okay, it's not even a fully formed candle. And what happens in trades is sometimes we get orders disappearing right around the time of the event. And when that happens, you can get a time of low liquidity. Everybody here probably has experienced the market maybe even freezing on us, or you try to get filled and you have a target and the price goes through your target. That's caused by low liquidity. If price I remember when I first started trading with JOBB, and I had a trade that took place, and my X's were on the chart, and my orders they went through the X's, and I didn't get filled. And if I would have gotten filled, I would have had a big winning trade. And because I didn't get filled, the price reversed. I got stopped out and I lost money. And I was so uneducated in those days that I wrote the broker, I called the broker, and I said, look, I don't understand what happened. There's something wrong with your system. I didn't get paid when I was supposed to get paid. The price hit my target and you didn't fill me. And and the broker was very patient. They didn't really explain to me why they didn't pay me, but they said, "Too bad. We don't pay you if the order doesn't fill." And he said there were no orders there to fill it. We filled you at the best possible place. So it took me some time to realize that just because the order seemed to fill on the chart, it doesn't work that way. But that's caused by low liquidity. So it's a good idea at times to check your volume, okay? And you'll come to know what's considered good volume or lousy volume. So let me show you a little chart that I made. If you go to New and you go to Market Analyzer, it brings up, in fact, everybody do it. Go to New and Market Analyzer. New and Market Analyzer. Please do it. If you hopefully your Ninja is booted up. You should keep your Ninja booted for all our classes, right? But if you go to New and Market Analyzer, you'll get rows and columns, a lot more rows and columns than what you see here. So the columns, you might have the ask price and the average daily volume, the bid price, the bid size. You'll just have a lot more, okay? And it'll look more like this. Well, so I took this list, right? And I right click it and I go to columns and all I put on it is instrument, daily volume, and days to rollover, days until rollover. I remove everything else, okay? Bid price removed, anything else, remove it. All I need is daily volume, the instrument, and days until rollover, okay? And then you could actually create a reset, a preset if you want, save it, apply it, and okay it. And then when you call up the market analyzer, right, all it'll bring up will be the instrument, the daily volume, and days until rollover. All three, very useful. Right click it, add an instrument. Let's say you want to know if the instrument you're trading today has good volume. So maybe you're going to look at gold, GC 423. Add the instrument. It shows you today's daily volume and how many days until the next contract, the change in the contract. So clearly, we're in the right contract. There's plenty of days until rollover. Many contracts are 90 days, many are 30, but most of them are not a day or two. And then volume, I would say volume greater than 30,000 is definitely tradable, no matter what the instrument. Sometimes we'll even trade an instrument with lower volume than 30,000 on the daily volume. For instance, copper, HG, is a pretty low volume instrument. And if we find the copper contract, it's pretty high because the day has been long, 76,000. But sometimes in the evening after the 6 p.m. market open, the volume will be very low. It'll be 6, 7,000. In that case, you're more concerned with liquidity. Now, depending which data you buy, okay, if you buy the inexpensive $12 data, one way you could look at liquidity is by going to New, opening up the Superdome, okay? And when you open a Superdome, you will see actually the orders that are available. Now, our Superdome, we actually have the cheap data on this particular account. And I'm only seeing one level of data, 6. It says 6 orders above. There's 6 orders available to buy, 6 orders, 9 available to sell, and it changes all the time. But when you have the $30, $39 data, you'll see rows and rows of numbers. And those numbers represent how many orders are available while you're getting ready to trade. And certain instruments have higher liquidity. Here you only have a very small amount of orders right now on the YM. YM is a pretty low liquidity instrument. Bonds, on the other hand, are much higher in liquidity. So if you look at ZN 623, the current bond market, you'll actually see thousands of orders, okay? And you'll see rows of them, rows of them. So you can check the liquidity on the dome before you trade. And that can sometimes, especially in the evening, give you an idea if if there's enough liquidity to take a trade. If there's one or two orders, or you see lots of empty spaces in between the other numbers. In other words, there's rows that are blank. That gives you a heads up that you may be having a liquidity problem. And sometimes you don't want to trade if the liquidity is terrible. Okay. So it's just something to keep in mind. I'm not, obviously, I'm not ever trying to scare you out of doing anything. I'm always just trying to arm you with information. Okay. So liquidity is something you want to be aware of. It's not something that often prevents us from trading, but sometimes it'll give you a good idea if you have a trap trade and a breakout setup and you're choosing between one or the other. If your liquidity is very low, choose the trap trade because the trap trade works better in low liquidity. All right. Now, so risk tolerance, we talk a little bit about that. Risk, there's different levels of risk. You've got risk that's related to how risky is a particular trade, and you have risk that's related to how much are you willing to risk on a certain trade, on a day, or over the course of 24 hours. So again, I look at each report as a separate entity, and I do not like to limit the way I'm going to trade based on whether I've lost too much money that day or not lost a lot of money that day, made a lot of money. I definitely don't like to limit myself if I've won a lot of money, especially if a good report is coming up. Okay. Now, probably one of the trickiest aspects of bankroll management is managing your stop. And it's definitely the most controversial aspect of bankroll management also. And again, because it comes down to that whole issue of, do you trade a system like a robot or do you trade a system with flexibility? So let's just explain one thing about how things occur. When you take a trade, and you know what? Let's use today's bond trade. It's a perfect example of stop management. I believe that there is no hard and fast one size fits all for stop management. I just don't think you can just say, okay, for every trade that I take, I'm going to never move my stop at all. All right. It's perfectly valid way to trade, but there's times when maybe the move isn't what you expect and you want to shrink your stop because you're just pretty sure the trade's not going to work out. You do not have to take a full loss ever. So moving your stop is an absolute for me. It's something I will do. Now, in this particular bond trade, I kind of know better, and I also know the kind of moves we get in these bond reports. I've been trading them forever, and I still can't always do the right thing. It's hard to be perfect. And look at what happened in today's report. 32 seconds, the bonds shoot down. It's a beautiful event. And I immediately move my stop to break even plus 2 ticks, 3 ticks. I start trailing my stop. And really, that was poor stop management. Okay. That was poor stop management. That stop management cost me money. What I should have done was just chilled out a little bit. Dude, wait. Let the report breathe, right? Give yourself a chance to make some money. It was a beautiful explosion in the direction that you were filled. Okay? No reason to jump out of that trade. It hit my first target. So what I should have done, what would have been so much smarter, would have been to move my stop maybe above break even, you know what I mean, below break even by 2 or 3 ticks, rather than so fast protecting profit that it cost me profit. So stop management is so important. If you could learn to recognize patterns, right? And I know this bond pattern. It was a pattern that should have continued, and it did. And I should have chilled on my stop movement and made more money. Okay. There's times when, yeah, you want to move your stop as fast as humanly possible and get that stop protecting you because that's what a stop does. And you know, we have a lot of features in the software that the stop does move and it will protect you automatically. Target one stop move, target two stop move, trailing, all of those features will help you to move your stop automatically. In this particular case, stop management hurt me. There will be times, like I said, you will want to move your stop because the report may not be working the way you want, and you can protect a huge loss and make it a small loss. How do you open the Superdome? Okay, go to New, Superdome. It'll show up on your chart, on your monitor, I mean. If you have a second monitor, that's why I had to pull it in. Shows up on my extra monitor. And then the Superdome, you just type down here, you can choose your symbol that you're going to use for it, oil, for instance. Okay. And those are the prices just like they relate to the chart. The reason you don't see me use the dome hardly at all, I came from TradeStation. They have a very ergonomic dome. I do not like Ninja Trader's dome. I feel that when I use it ergonomically, the way that I feel is natural, it puts me in trades that I don't want to be in, and it just doesn't work the way a dome should work. For me, I cannot use it. All right. And it's not something I want to spend time learning. We have chart trading on Ninja Trader. You don't need a dome if you don't want it when you can move your orders up and down. It's perfectly a good replacement. There's plenty of people that use the dome, but I can't because it's just so foreign to me the way that it works because of the other platforms that I used before I was using NinjaTrader. So stop management is important. Sometimes you're going to leave your stop in place, let the report. So why sometimes might you leave your stop in place? If you're trading a report and the news totally agrees with you, okay? I'm trying to think what report did we just recently trade? I think that let's look at ADP real quick because I have it here. Now, ADP did not work that great today, but fortunately, most people did not. No, only one person lost money. Most of us made money, even though it wasn't great. Or some people didn't get filled. Some people didn't get filled. Here's the thing ADP, the news was very positive. Okay. So it did push the price down on gold, which it's supposed to do. If the price is good, if the news is good, we still do expect gold to push down. If the news is negative, gold still has a tendency to push up. It just doesn't do it as often as it used to years ago. And it may change back one day where it will. And bonds do the same thing as gold most of the time. When the news is good, bonds tend to push down. When the news is bad, bonds tend to push up. And one of the problems is today the analysis of the news is schizophrenic, like we were talking this morning in the trade room. Sometimes good news is bad news because it's now inflationary, whereas a year ago it was just good news. So those are things we just have to deal with. It's more complicated to analyze the news. But with news and stop management, when your news is drastically good or drastically bad, that can help you with stop management because If you're trading the ES and the news is drastically good, the market is going to go up, right? So if you're in a trade and you have that kind of a news result, don't shrink your stop too much. Let the news be your guide. We know that sometimes the instrument doesn't follow the news, but more often than not, it does. So let the news results help you with your stop management. Now, there's another important thing about managing risk and bankroll management, and that's number of contracts. Two things about stop. Let me just say one more thing about stop and stop size. And I've said this before in the trade room, but I just want to make sure it's part of our class. People think, especially beginning traders, always think, okay, I've got a DMM trade. These guys at 10-minute trades, I think they're pretty smart. They know what they're doing, but you know what? They're not that smart. The stop, it's way too big. It's way too big on this report. It's too much to risk. I'm going to shrink that stop and I'm going to make it smaller. Well, sometimes, well, don't forget that we didn't just pull that stop out of the wall, out of our ear. We took that stop based on months and months and months of studying the reaction to that event. And that stop makes sense. It's not like a random number. It's not a random number generator. We're not throwing a dice. And so what happens is a beginning trader will say, I don't want to risk $300 with a 30 tick stop on this trade, trading gold. I just want to risk $100. I'm going to bring my stop down to 10. So believe it or not, shrinking your stop and having less risk of dollars in the trade cost you more risk because you made it more probable that the trade's going to be a loser by using the wrong size stop. So understand that shrinking a stop does not necessarily mean less risk. It may very well mean more risk if you don't know why you're shrinking it. Okay? It's always important to know what you do. And also, another thing that's important about the stop. Let's say you have a bracket trade with a bracket of 10 and a stop of 10. If you increase your bracket to 15, your stop should also increase to 15. If you have a bracket of 12 and you increase your bracket and you have a stop of 20, follow a bracket of 12 and a stop of 20, and you increase your bracket to 17, increase your stop 5 ticks also, go to 25. Anytime you increase your bracket, you should increase your stop the same amount of ticks. If you shrink your bracket, keep the stop the same because that's the minimum stop we feel you should use. Don't shrink it just because you shrunk your bracket. Shrinking the bracket will give you a potential for more profit if the price moves in one direction. But don't shrink the stop unless there's a good reason, okay? But if you increase your bracket, increase the stop. And I believe the same thing could be true on a little bit more limited basis with a trap trade. Remember, on the trap trade, you have a zone of safety. So if your stop on a trap trade is 20 ticks and your outer tier is 20 ticks, your zone of safety is 40 ticks. But if in your research you realized if you have a 44 tick stop, most of your trap trades will be much safer, then just use a bigger stop or keep in mind that the tier, your outer tier and your stop is what you need to equal 44 or greater, right? If 44 was the average move that a trade took and you're trading a trap trade, if your outer tier is 30, then your stop needs to be at least 14. 30 plus 14 is 44. Okay? So always remember to keep an eye on your stop on a trap trade. It's not the same thing as you increase your stop just because you increase your tiers. That's not always the case like it is in a breakout trade. Okay? Any questions? Does everybody understand everything so far? This is all, it's good stuff. It's not complicated. A lot of times trading is just common sense. It's not that big of a deal when you understand why to do things, right? It's common sense, a lot of it. Two more big things that I want to cover today. Um, Multiple contracts. It's actually, even though it could cost you more in a trade, it's much easier to trade multiple contracts than it is to trade one. I believe it's much less risk to trade multiple contracts also because it's so much easier to trade more than one contract than it is one when you're trying to figure out how to make money. Think of it this way. So if you have a DMM, right? And let's talk about tomorrow, natural gas. Because I want to trade natural gas live tomorrow, okay? Natural gas has been pretty mellow, I think. So if you realize we have two targets for natural gas, 15 ticks and 30 ticks. And I'll wind up showing this. You know, we could look at last week's natural gas trade. Let me get the trade and I'll show you natural gas was pretty slow moving last week, if I remember correctly. And the point is, when you trade one contract, you have to guess where to put your target. Now, you know, we're never just guessing like a dodo bird. We're guessing based on knowledge, right? We're guessing based on what's possibly going to happen based on a previous move. So you should never be doing anything totally random as a general rule because we're using all of our studying of the events to know how to trade. So, and to where to place targets. So, but when you're trading one contract, so you have a natural gas DMM, where are you going to put your target? We have a target of 15 ticks and we have a target of 30 ticks. Where are you going to put your target if you trade one position? You're sort of guessing. You know that you're guessing with intelligence, but it's still much less of a probability working because you don't know if it's going to be a big move and hit your second target or if it's going to be a smaller move that week and hit your first target, go closely to first target. So when you're trading with one contract, it's much harder to come up with a valid trade setup. When you're trading with two contracts, you've always got that first target that helps you modify and control your stop management. If you hit your first target, and watch what we did, I'm pretty sure last week I would have done what I think is good stop management. So last week we traded natural gas. And it was in sim, and it doesn't matter. You can practice good stop management, live or sim, makes absolutely no difference. So last week, watch what happens. We're trading the breakout on the left side here. All right. There's our brackets. We're going to get filled. It takes a few seconds. The market's going to push. It's going to fill us. And I remember it was a pretty slow, easy to trade natural gas trade. In fact, my boss called it a cancel because it didn't fill in 10 seconds. I would not cancel because we're seeing slower responses from natural gas, especially the price being as low as it is. Natural gas was more than $7 this year. So it was a very slow fill, but watch when it fills. You're thinking about stop management. All right. So the first thing I'm thinking when I get filled is how quickly can I protect profit if this trade goes into profit? I can't think of anything more important than protecting profit. Now, I shrunk the chart and I should be getting ready. There I go to move my stop. I'm moving it and shrinking it so that it protects the profit. That to me is smart stop management and Because I have two positions, when it hits my first target, I have a rule set to what I'm going to do with my stop. Now, that rule set can have a bunch of different rules. It could be in a volatile event, it could be move your stop halfway to break even. It could be move your stop to break even minus 2 ticks. It could be move your stop to break even plus 2 ticks. But the point is, it's much easier to figure out a stop management system when you're trading two contracts because you have much clearer targets and their definition, they're defined because they're really clear. You've got two targets on the DMM. When you hit the first target, you have a system in place what you're going to do at your stop. You're going to protect your profit or at least shrink the stop so that you're losing less if you get a complete reversal in the trade. The one old wives' tale that I do like, I'm not married to it, but I do like it, and it's don't turn a loser, don't turn a winner into a loser. That makes sense. If you have a real nice winner, don't watch it turn into a loser. It just doesn't make sense to do that. Don't let a good winner be a loser. Okay? Move your stop, move your target, do whatever you got to do to protect profit on a great trade. There's no reason to let a really good trade turn into a loser. That's just bad management. Okay? So stop management, many different ways to deal with it, and some of it is very personal by the risk that you are willing to take and the amount of risk you want to deal with. Okay? The next and final topic for today is something about margin and micros. Margin and micros. So, what is margin? All right. So, if you have an account, you got to put money in the account, real money, and the broker is in this business to make money, and they're in this business not to have you cost them money. One thing you can count on is the brokers are not our friend. They're not our enemies, but they're not our friend. They are not in this to help you. They are in this to make money. That is just like any other company. So the margin is set for them, but margin affects us dramatically. What margin is, it means you have to have a certain amount of money in your account to trade, or you're not going to be allowed to trade. So I'll tell you what, let's do something kooky. Let's have some fun. Let's have some fun. I love AI. I know it's a pain in the ass to hear about it all the time, every second. I'm sick of hearing about it. AI, AI, AI. Everybody talks about it, but I still think it's fun. So let me see if I could even remember how to do my AI. But for instance, I don't want to get caught. I don't want you guys to catch me doing something I shouldn't have done. But I'm going to tell you the truth. I got some of my definitions of bankroll management using AI. It's great. So, what is margin? Let's say, what is trading margin? Okay. This is ChatGPT. Margin, look how fast it generated. Margin in trading futures. It's amazing. Margin in trading futures. Let's see, where did it go? Where did it go? Where did I put it? Where did I put it? Here it is. Refers to the collateral that a trader must deposit with a brokerage firm in order to open and maintain a position in a futures contract. Fantastic. Perfect. Really, really good. It's like how much minimum money is needed to do the live trades. Okay. So keep in mind that with us, you need double the margin for a breakout trade, right? Why? Because when we create a breakout trade, right, with two orders, Let's see if it works. It's not going to work because what did I not do? Don't forget, if you're teaching a lesson, make the time 0, right? If the time's not 0, it won't work. So let me back up and make my brackets bigger. All right, my brackets have to be bigger, but we are double the margin because we're putting 2 brackets, one above and one below, and the brokers count that. They count that as 2 margin, not 1. So if their list, if you look at the margin requirements, and everybody, I'll post this list, okay? Let me get the margin requirements for you, and I'll post it. And Ninja has done a lot of changing to their website, and there's a lot of controversy about their new upgrade. Do not upgrade to the new version until you hear from us. No upgrading at the moment. Here's their margin sheet. I'm posting it in the chat. Okay. Keep that handy. Keep that handy. All right. So one of the biggest mistakes that beginner traders do is they call me up, or don't call me up. They send me an email. What's the smallest account I can trade? I'll say it again because it drives me absolutely insane. What's the smallest amount of money I can open an account with? Why would you want to cripple yourself as a trader so that every time you trade, you have to worry about how much money you have in your account? The correct question is, what's the most amount of money I can afford to put in my account? Make everything you do so that it's a benefit, not a negative. Make every act you take an act that helps you make money, not an act that hurts you. If you're trading with a small account, and I'm not saying don't trade, sometimes you can only afford so much money. But if you can afford more and you don't put it in, you spend too much time worrying about getting stopped out. You spend too much time worrying about a bad trade. So it winds up being that you kill your psychology. We all know that psychology is the most important element in trading. If your psychology is good, you're going to be a good trader. I'm telling you. If you can master the psychology, you're going to be a successful trader. Even a monkey can learn to put numbers into a software program, right? That's the easy part. Beating the psychology is the hard part. So don't make it hard for yourself. Put enough money in so you don't have to worry about the margin every trade, every second, every minute. That is a hindrance, okay? However, you still have to understand margin. So let's say, for instance, you go to NinjaTrader's margin sheet. That's what this is. It's a margin sheet, right? It's the margin explanation. And if you're going to trade the NQ, we use intraday margin, all right? Intraday. The intraday margin is $1,000 for every NQ contract. So if you're trading 2,002 NQ contracts, that's at least $2,000 needed in your account. What I like to do is add at least 500 to $1,000 above that. So if you want to trade 2 contracts of the NQ during the day when you're allowed to get the cheapest intraday margins, me personally, I would probably want $3,000 in my account to trade 1 NQ. Honestly, 1 NQ. You could trade 2, but you'll probably be worrying about your account, right? Because you're not going to have enough money if you have a couple of bad trades or a bunch of bad trades. The mini, or the micro, the MNQ only requires $100 in margin. So you can per contract. So you could trade more contracts and practice well with the micro. Okay. So micros are really good, especially in small accounts, and they're really good if you want to, use more contracts for practicing. And they obviously require less margin. So this Ninja sheet will show you all of the instruments that you can trade with Ninja. And it lists all the micros. There's micros to so many things now that there didn't used to be. Some of them aren't that great, okay, because they're not popular, so they don't have good liquidity. But more and more, the micros are getting more and more popular. People love them. The brokers love them because don't get lost in the fact that you can still blow up an account trading micros. You could lose your money. You can get very lulled into complacency because micros seem like you don't lose much if you lose. But trust me, losing adds up. You want to use the same care and the same intelligence that you would use in a full size contract trade. Okay. Now, sometimes you'll hear me say, oh, okay, we could test this using micros. And yeah, the beauty of micros is you're risking way less money on a trade. So you can do a lot more live testing. And you should allocate some of your budget for live micro testing because no trade is a good trade better than a live trade with real money. It really shows you what the reality of the trade is. Okay? What happens is when intraday margin ends, when the broker tells us, hey, we're going to raise margin for a particular trade because we think it's too risky for us, not for you, for us, because we think you're going to blow up your account. And we want you to make sure you have enough money to pay us. If you do, we're going to raise the margin. They usually use the initial margin or the maintenance margin to come up with the margin they're going to require you to use. And they will tell you in their email or in their rule set. But to give you a ballpark, the maintenance and the initial margin are very close. But to give you an example, if there's a high margin trade and this Friday's jobs report is a high margin trade, all the instruments that we trade go to at least maintenance margin. So that means that bonds, which usually are $500 per contract, are up to almost 2,000 per contract. The NQ goes really crazy. It goes to, hold on, I forgot what it is. The NQ with high margin 15,000 per contract. These brokers are not protecting us. They're protecting themselves. Okay. They don't want you to trade NQ when they think a report's going to be too volatile. This list will show you how much money you need in your account. What I would do as a good rule, there is no perfect rule, but most of the time we are trading intraday margin. That's what Ninja Trader allows. So if you're trading, for instance, the Australian dollar and it's $500 per contract, and we're trading a trap trade, that's four margin, four times 500, two orders above, two orders below. So they consider that four positions. That's $2,000. I personally like to double the margin for what I think is a safe amount in the account. But let's be honest, if you have $200 more than the margin, you'll be allowed to trade. But your trade, it could be closed automatically by their computers if the amount of money in your account goes less than the margin required. So in other words, if you're trading for Australian dollars and you go below $2,000 of value in your account during a trade, they are in their right to shut off your trade and close you out wherever you are. So you should know at least how to find the margin, which now you can do, and to figure out what could be safe how much you should have in your account to trade. But I truly believe with everything that the best thing you can do is to, carefully trade and put in the more money you can afford to put in rather than the least. Putting in the least is really a ticket to worrying too much. Okay? So I don't want you to think minimum. Think what's the most I could put in? What can I really afford to make trading so I don't have to worry? The less you worry, the better you're going to do, the more you're going to make. It's that simple. The less you worry, the more you make. It's a guarantee. Okay? All right. Micros. So micros, it's really trading. A couple of tips you might want to take into account. You can use bigger stops with micros. Micros will give you a little bit more. Sometimes they're a little bit more whippy, depending on the micro, but our experience is the gold micro is a little whippier. You can use bigger stops and slightly bigger brackets to make up for that. There's no reason why you shouldn't test micros specifically. Okay, they do move differently than the full size. You can use your full size as a guide, but if you want to be really fanatical about it, and fanatical means you'll probably make more money if you're super careful, then you can test micros the same way you do all your testing on regular contracts. Okay? Any other questions? So, what's our action item of the day today? So, I was thinking about all the things. I really haven't made anybody do anything difficult at all for action items, but I would like everybody to do something that really I think will help you. So for an action item today, and it's not necessarily related to what we're doing today specifically, but it's related to the last couple of days calendars and testing and trades. How about design a trade and just write it on paper? When I say design a trade, so what do I mean? I mean, go to the calendar and find one event. Find an event on the calendar. I'm worried no one's going to do this. All right. Find an event on the calendar. So I'm going to do it. So we're going to go to Forex Factory. All right. Go to next week. Okay. Go to next week. Just click the top little arrow after you click calendar. Okay. Click the right arrow. We're in next week. Find an event that you don't know, but that's red. Okay. And then just post post the picture to Facebook. Okay, so take a picture of the calendar. Everybody knows how to take a quick picture. Take a picture of the calendar. So I'm going to take a picture of the calendar using the snipping tool, right? I'm going to use the claimant count change, all right? So I took a picture of the claimant count change, and I'm going to save that. My picture got screwed up, so let me take it right. And I'm going to save it. And then all I want you to do, and it's not hard, I'm going to make it easy. Just design a breakout trade, just brackets and stops. Okay? Just bracket and stop. You know what? This is going to be too tough because then you got to take a picture of everything. Forget it. Forget it. I'll tell you what I want you to do. Just everybody, let me know you understand margin. All right? Let me know you understand margin. Post post to Facebook the margin sheet, okay? Post to Facebook the margin sheet that everybody got today, all right? So I want you to post a picture of this margin sheet. That way I know everybody paid attention. It's real simple. Take a picture of the margin sheet, post it to Facebook, telling us I understand margin, okay? That's what I want everyone to do. And I'm going to post it to my Facebook right now. If I could find my Facebook, it's around here somewhere. There's my Facebook, and I'm going to post it. So all I'm going to do is I'm going to write something. I understand margin, and then bring in your picture. Okay, and post it. That's what I want everybody to do. Then I know everybody's understanding margin. You're understanding what the micros are, right? Because all the micros are listed. You're understanding all the contracts, okay? Very simple, but it's important because then I know you can get the information you need before a trade so that you could trade safely, okay? Fair enough. Is there anything that anybody needs me to go over today before we get into our next class? Anybody? Otherwise, we're good for today. If there's nothing that anybody needs to go over, it's been a long day. Have most of you been in the trade room today? Did most of you trade or watch the trades today? I know you were there, Alan, most of the day. Matt, you wanted to know about the squeeze. So, Matt, I'll tell you something quickly about the squeeze. So, Matt was asking me about the squeeze indicator, which is this indicator right here at the bottom of my chart. So, Matt, I'll give you a tip about the squeeze, a way that we've used it. So, very simple, folks. Look at the price action of the YM at the end of the day and towards the close. The squeeze is a great momentum indicator. Clearly, it's going up, 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 and then the YM changes direction and really is consolidating, and the squeeze changed direction. Even though it was consolidating, the squeeze actually acted like price should have been going down further than it was. But nevertheless, that's very common squeeze behavior. Okay? It's very common squeeze behavior. And you can use the squeeze to help you to find a trade after a news event. Make believe this was a news event, okay? And the price was going up, up, up. The news is over. You now have an indication that you have a change in direction. So maybe it's safe to take a short there. That's the most popular way the squeeze is used. But there's another way you can use the squeeze. If we look at price, and I just want to find a good example of it. A lot of times you'll be in a short, right? For instance, you might be in a short trade, a trade to the downside, for instance. And I just want to find one that's working, not one that failed. Okay, so give me a second because I have to find the right price action. Perfect. So look, we're in a short right here. 11:30 this morning. The momentum is increasing to the downside. Look what you got going here, Matt. You've got a change in color and momentum, but we're not green. We're under the zero. But that's actually a sign to go long. And look how well it worked. It's a way to use the squeeze early. Right here, you got a signal to take a long. Even though momentum was under zero, and that's not where most people would have gotten long. Most people would have gotten long over here. So it's a way to use the squeeze faster. That's how we have used the squeeze over the years. It works even better at times if you put your chart on 30 seconds and you change one default value of the squeeze. It's an indicator. So to change its values, you click on indicator, highlight the squeeze, and on momentum length, you make it 17 on a 30-second chart. Apply it and OK it, and it sometimes will give you an even earlier signal. Now, I don't remember exactly what time that was. I think it was 11:30. But you might have gotten a little bit earlier signal to go long. Okay, so you're changing the momentum length to 17 on a 30-second chart. And the squeeze works really nice that way to help you find. The original default, Matt, I believe was 20. But when you load your squeeze, I'll bet you if you check the squeeze that you downloaded, it was probably set to 20. And the way that I have my colors set, just so you know, is the important ones are above zero rising, above zero falling, below zero falling, below zero rising. You just want green and dark green, red and very light red. Green and dark green. The bottom four: green, dark green, red, and light red. Okay. And you can clearly figure out the way you do your color. You just want to be able to see clearly a momentum change. Okay. So that's a cool way to use the squeeze. So that was just a little extra bonus today's class. I want to thank everybody for joining with us today. Tomorrow we will be at noon. We're getting close to the end, so let me just remind everybody that the Friday class is going to be a review of going over what you got to do to win the challenge. So definitely use the link that you've already signed up for to come to Friday to sign, to review the challenge rules, winning the challenge, etc., etc. And then Monday, and Eric will send an email on all this. Here's the link one more time. Monday will be the final training, and it'll be the winners announced, and we'll be watching videos. Hopefully your winning video. Okay? Any questions? It was another good class, I think. How'd you like the class? Was this a good class? Everybody liked this class? Give me a thumbs up or not so good. You're not going to hurt my feelings. You're not going to say bad, but thanks anyway, folks. Post your margin sheet on Facebook, okay? Post your margin sheet on Facebook. That way I know you're listening and I know you know how to do your margins, okay? And you know how to look up your micros. I know you know that to find your instruments that you can trade, and I know you'll be able to tell how much money you should have in your account, okay? That's all important stuff. And I know it's going to help you to trade better. All right. I'll see everybody in the trade room tomorrow. What time are we starting? I think we're starting natural gas 10 o'clock. So I'll see the folks that are in the trade room tomorrow at 10. Alan, if you don't have it, it's definitely been emailed. Send me an email, help@10minutetrades.com, and I'll email it out to you. Okay, everyone. Have a great day, rest of your day, and I'll see everyone tomorrow. Take care.